Earlier we showed you what a flag looks like, so here we're gonna take a look at it in more detail and show you how to actually trade it. So what is a flag pattern? It's a continuation pattern that is very key to understand that. So meaning that if you find it in a bullish market, you're basically gonna be expecting a continuation to the upside. So we're waiting for that opportunity to join in the uptrend if we missed the uptrend, the beginning of the uptrend, right? So that you can continue with the trade. So it's very key to know that it's a continuation pattern. A flag is composed of an explosive strong move that forms the flag pole. So this is our flag pole, as you can see labeled over here. This is our flag pole. It's an explosive move, meaning that it's just a strong move in that direction that the market is going, followed by an orderly and diagonally symmetrical pullback. So this is our pullback right here. As you can see, this is our resistance level and this is our support level, and the market is just basically ranging in between these two right here before it breaks out, right? So this is what we call our pullback. This is our pullback session over there that is happening over there, and that pullback is what forms the flag that is connected to the pole, right? So this is why we call it a flag pattern. So when the trend line of the flag breaks, so the trend line over there to the top, because remember this is a bullish continuation pattern that we're looking at right now. When the trend line on the flag breaks, it triggers the next move that proceeds ahead. So the pole formation represents almost a vertical and parabolic initial price moves, separate the flag from a typical breakout or breakdown. So it can be in a bullish or in a bearish market. So this is a bullish flag that we're taking a look at right now. So with a bullish flag, the pattern starts with a strong spike that takes short sellers completely off guard. So as you can see right here, started building up slowly, but then eventually just all of the sudden it just became explosive and gave us some huge candles in the decisive direction, which is a bullish market in this sense. The price peaks and forms an orderly putback where the highs and the lows are literally parallel to each other. So upper and lower trend lines are plotted to reflect the parallel diagonal nature, so that we can see where the market is bouncing off to the downside as well as to the upside. So this is our resistance and support, right, that we're looking at. So the breakout forms when the upper resistance trend line breaks. So when the upper trend line is broken, so this is the trend line that we're talking about right there, which is our resistance at the moment. So when it breaks out, as price surge back towards the higher of the formation and explodes straight through that resistance line to trigger another breakout and beginning of an uptrend move, right? So the continuation of that uptrend move that has been going on. So one key thing that you need to notice about this pattern is that the sharper the spike of this flag pole right here, the more powerful the bull flag actually is. So it's very, very key to know that. So the sharper it is, the more powerful this bull flag is. So to give you a clearer perspective on this pattern, basically this is how a bullish flag pattern actually looks like. So we have our movement here, at least an 80 pip movement upwards. So this is the formation of the flag connected to the pole, and we have our support and our resistance, and the price basically bounces off here. So we have our first entry. Our first entry over there, our first entry will be here. This is where we're looking out for our first entry, just when it breaks out of that resistance and turn into support. And our stop loss is basically below this support line right here that was supporting the market, because remember we said around any support or resistance level is where a lot of liquidity is, and the stop loss hunting basically occurs around those areas. So we want to be a little bit away from those lines, but basically around those lines, right? That's where we want to put our stop losses at. And then as you can see, our target profit here was basically 80 pips, because this move was also 80 pips. So that's basically how you can measure it, and that is our target right there. So our entry at number one, where the price breaks to the upside and continues in the uptrend, and then our stop loss just below the support structure that was supporting the price in the flag. And then we have our target point is at least at the same height of this movement that our pole actually spiked out to the upside. So we're looking at that to make our take profit, right? But remember, you can also make use of the trailing stop loss so that you can make the most of it, so that maybe it will continue moving to the upside more than 80 pips. That way you'll be able to trail stop. So making a use of a trailing stop here would be more effective, because remember with the TP, if it hits that 80 pips, then you are out with that profit, which is good. But on the upside, with this kind of movement, if the bullish trend is actually very, very strong, it might actually carry on for maybe 2 times, 3 times that amount of pips that you have secured. So making a use of trailing stop is actually very, very effective in this sense as well. Okay, so we have seen the bullish flag. Now here's an example of a bearish flag. A bear flag is an upside down version of the bull flag. So exactly everything that we just said about the bull flag is just the opposite, right? Just turned around to the upside. So it has the same structure but inverted. It just inverted and it's upside down. So the flagpole forms on an almost vertical price drop, as you can see right here. It's almost vertical, almost straight. That then bounces off as it forms a pullback. So as you can see right here, this is the parallel, giving us our parallel resistance and as well as the support line, which is the formation of the flag, right? Which is the formation of the flag. And then when it breaks out there, that is when we are looking out for our selling opportunities. So when the lower trend line breaks, it triggers panic sellers as the downtrend resumes another leg down. So as it continues down, the drop on the flag pole determines how strong the bear flag can be. So this drop right here will determine the strength of this bull flag. So the longer it is, the more powerful the movement we can expect after the breakout of this trend line right there, after this support, which will now be turned into resistance. So that's basically what we are meaning over there. So a clear illustration of this. So we have our almost vertical pole right here, which is the price drop that will be happening. But remember, this is a bearish market is going down. Our entry is when the market breaks through our support over there and turns into resistance, and then that is our entry point, right? And then this is our stop loss. Our stop loss, as I said, you need to put it a little bit away from the previous resistance point right here, because remember we said this is the most liquidity, this is where the most liquidity is, and the stop loss hunting can come back all the way to those levels. So you need to be at least give the price some room to breathe in case it comes back to retest those levels again before going in the direction, right? So this will prevent us from being stopped out. So you knowing that this is a liquidity phase or liquidity area, in that case that you actually know, okay, cool, I need to be aware of stop loss hunting. So it's very key that you understand these things as well. So and then this will be our targets. The more powerful this move to the downside is, the more powerful of a move you can expect here. So you can roughly range that amount of pips that has been moved here as the next move that will be happening after this breakout. So again, you can make use of trailing stop loss to make the most out of this trend in case it actually continues down way more past that 80 pips point, right? So flag patterns require the patience to wait for the flag to form, as well as for the breakout to come, right? So the lower and the upper trend lines will contain your entry and stop loss and your stop loss levels, right? So that is just what we just explained now. Trailing stop loss, it will help you to capture the whole trend in case it actually continues going further than the 80 pips that we are anticipating the market to move at this point after the breakout. Psychology of the flag pattern. So flag pattern starts off violently as the other side gets caught off guard on the move, as the bears or the bulls become over ambitious. So on bull flags, the bears get blindsided due to complacency as the bulls charge ahead with a strong breakout. This caused bears to panic and to add more to their shorts. So once the pair picks out, so when we're having that pullback, the bears regain some confidence as they add to their short positions, only to get trapped again when the breakout forms, causing more short covering. So since sellers from the initial flagpole run up may be still trapped, the second breakout forming through the flag can even be more extreme in terms of the angle of price move. So this is when forced liquidations and margin calls kick in. The same happens on bear flags, just inversely. There are two entry spots on both bearish and bullish flags when playing for the trend continuation break. So the first entry is on the flag break, and the second potential entry is on the break of the high of that flagpole. So what we mean by the high of the flagpole is basically this point right here, or at least this point right over here. So the highest point of that flagpole is where you are looking for your second potential buys when you're in a bullish market. And then if you're in a bearish market, you're basically looking for the break of this lowest point of the second pole. So that would be a second potential entry. But the first one, as we said, is at the break, right? At the break of that support or resistance level. So that is what we mean by the break of the high of the flagpole or the break of the low of the flagpole. So first entry is an early entry that allows the trader to capitalize on an initial move back to the high of the flagpole before the pair rejects or breaks out. So where should you actually put your stop loss spots? A flag pattern also allows for 2 measured stop loss levels. If the pair fails to hold its momentum, the initial stop loss can be placed under the upper trend line on uptrends and lower trend line on the downtrends as a trail stop. So as we showed you earlier on the when we were demonstrating that, so target levels, which is our take profit, the target levels can be anywhere when you enter a flag pattern. It is also wise to use a trail stop or move stop loss to entry point. The initial targets on all flag patterns will be higher or lower of the flagpole. So the flagpole is very important when you're determining our target levels so that we can have our take profits. Otherwise, as we said, it's pretty much wise to use the trail stop loss so you can capture the whole trade in case it continues. Because I mean, this is a trend, right? It's a trend that is continuing. So a continuation in a trend is usually very strong, and it might actually carry on more than what you may anticipate. So it is very wise to use the trail stop loss.